Well, we're going to talk this morning about real estate prices and processing loans, as well as the general status of the market, given the fact that Europe seems to be in the toilet and Treasury bonds are soaring, Treasury yields are plummeting, mortgage rates are at all-time lows. What do you make of all this?
Well, you know, when the prices are going down, sellers are hesitant to put things. I mean, you know,
It was catch a falling knife, right?
right. I mean, the sellers have been very concerned because they didn't know where things were going. So a lot of the sellers were actually putting a lot of stuff on the market, right?
Yeah.
And buyers, but then they didn't want to buy. Now that things are stabilizing and potentially even coming back up, sellers are saying, well, wait, maybe I don't want to put it on the market right now, and I'll wait until the prices actually start coming back up. And we're seeing that there's a shortage of listings on the market in some markets.
That's good if you're a seller. It may not be so good if you're a buyer.
Well, you know what's happening? There was an article in in the Los Angeles Times this weekend about the fact that in a lot of markets in LA, buyers are actually bidding for houses again, back like they were in the boom. And we've seen the same thing down in Florida. We've heard stories in Tampa and other places.
So you think these banks, because of that, are finally going to clear out their inventory?
Well, it would certainly seem that the market is changing. You know, and we've had.
Think it's stabilizing? You think it's stabilizing? You think we're starting to see?
Well, you know, it's never going to be uniform across the country, and so what we're certainly seeing is that in some markets it's stable, some markets it's starting to go back up. There are a few that are still going down, but on average, I think it's definitely stabilizing. All the indexes are now showing some gains, and so we're getting there.
A lot of it is your perception about the future. So if prices are declining and you think they're going to keep coming down, you're going to wait if you're a buyer.
Exactly.
Because you think you'll get a better deal tomorrow than today. And if you're a seller, you want to sell today in a falling market.
Get it out there and get it now before the prices drop. Yeah.
But conversely, if prices are headed up, if you're a buyer, you want to buy it now.
Right.
If you're a seller, not so fast.
Right, and because the interest rates are so low, the buyers have been in there saying, hey, now's the time for me to do it, but where's the inventory? The inventory's all of a sudden dried up in certain markets.
So it's not about how much you pay, it's about how much you pay per month.
Right.
Which is, the old phrase, can you tote the note?
Yeah.
And with rates as low as they are, that's a good thing.
And, you know, and here at F&C, we've been having all sorts of discussions with lenders and investors recently, very interested in starting to buy some of this volume that's being generated by some of these small banks and trying to open up their correspondent work.
Well, and many of the lenders have got their correspondent channels. They basically are collapsed.
Yeah.
And so they're having to rebuild those channels. If you were a seller of a loan, you would want that correspondent to say yes as soon as possible, and your yes to be a real yes, not a weaselly yes.
And some of those yeses are going out 3, 4 weeks, 5 weeks, before they get that firm yes.
That means that somebody has either got to take the interest rate risk, because that chances are that closed loan is at a fixed rate.
Yeah, I would think.
Somebody has to take the interest rate risk, or somebody has to hedge that loan. And the longer the processing time to say yes, the longer the hedge.
You mean it costs money to hedge?
It costs money to hedge. There is no free lunch. There may be in economics, but in finance there is no free lunch. And so correspondents are paying somewhere between $10 to $20 per loan per day to hedge that. And if you take an extra 10 or 15 days, if you process very many loans, that's a lot of money.
Well, think we can do anything about that?
Well, we can shorten the time period. I mean, really, in an ideal world, it's already a closed loan. The money's already out the door from the originating lender. So in an ideal world, a correspondent ought to be able to say yes on a very high percentage today.
Well, it's always puzzled me that
same day
we have all these lenders that are using loan origination systems. It's all data in their loan origination system. They're processing all of that. It goes to the closing agent, and they make some final adjustments on the closing agent, and then they generate the documents. At that point, it all becomes paper or an image, and all that data is just out the window. And so when the closed loan then comes to the correspondent buyer, the lender who's buying those loans, and they have to deal with all this paper, and there's no automated way to review that stuff. It's crazy.
It's amazing. We experienced this in appraisal years ago. There was no consistent way to review an appraisal. And you and your team wrote generally accepted appraisal rules, and now there's a standardized process by which to review for compliance, for risk, for external validation of the data, to review an appraisal.
Right. But the big hurdle there was to get that data, because back in the day when we got started, there were no easy ways to get the data out of their appraisal.
I had a lot of hair. You had hair.
Well, I had a little hair.
It was in different places.
I see. Okay. Yeah. I had long hair. That's what it was.
Exactly. Closet hair.
But yeah, we've got, now the problem is in the mortgage file, there's no data there. So, I mean, some of the buyers are keying it in, but that's very inefficient. I mean, very slow.
It's also prone to errors.
Right, and very limited the amount of data they can afford to put in.
So what they're doing is they're paying people that are highly paid to key in data they need to make the decisions they need to make, as opposed to having them focus on the decisions they need to make.
It's strange that the industry doesn't recognize this and standardize all this, and create some type of standardized way of closing these loans and generating that as data so that it can be all analyzed and reviewed.
Well, basically the uniform loan delivery data set that Fannie and Freddie have come out with is an attempt to do that, but really for Fannie and Freddie's benefit, not for the people along the food chain.
Right, and most of that data then is for the, like you said, for the GSEs, and it's not even a complete data set.
That's right.
It's a small data set.
So if we could back up and talk about re-engineering the process for the future, we would talk about some specific forms. People along the food chain probably need to know the 1003 application, the data out of that, all that data. They probably need the data out of the 1004, the appraisal. We facilitate that for them today.
Right.
And it's amazing what they learn just out of that data. The 1004, they learned how to benchmark their collateral risk. They learned they could measure the change in the amount of risk they were ingesting over time, as well as how much they were ingesting versus their peers.
Exactly. Yeah, and that's the whole beauty of having everybody do this data, is that all of a sudden now they become industry standards.
Right.
And right now everybody's operating in a silo. They don't really know what everybody else is doing. And
with all these discussions about operational risk, if we had the data, we could measure directly a firm's operational risk as it relates to mortgages.
Right.
We could also do that in terms of their credit risk they're ingesting.
Yeah, you saw this past week that the Fed is now going to be mandating the Basel requirements all the way down to the small banks.
They're all excited about that. They jumped up and down, and everybody's celebrating the small bank level this weekend.
Yeah, we saw, I think a lot of people decided to take a vacation this week.
A lot of alcohol. We go back to alcohol, especially. We're a long alcohol.
Yeah, well, we need to work on that a little bit more. But, if we could get this data and we could get everybody processing the data, we could create a lot of standards, got a lot of expectations, measure the risk, be able to understand what one lender is doing relative to another lender. All of that's good stuff.
And it would be good across all channels. It would ultimately be good for good borrowers.
Right.
For the good applicants, it would shorten their processing time. They would get better execution because we could segment the market a lot better, not just based on your credit score, but you could segment the market a lot better based on other variables. We may not know what those variables are today, but it would be good for all the market participants, and it would be good for the lenders.
Right. Well, all we need is for all the banks to listen to us and do exactly like we say.
It's amazing how agreeable people get when they have a few libations.
Okay, well, maybe that's where we need to work.
Well, this is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. You all have a fantastic week.